It's the lowest level of the day, I think, on the 10-year note yield. It does take us to our talk of the tape. How far can this rally run? A rally pushed again today by the AI hype, but some say in need of much more to keep the party going. Let's ask Adam Parker. He's the founder and CEO of Trivariate Research, a CNBC contributor, and he's back here at Post 9. Good to see you.
Good to be
here. Been a remarkable run, a remarkable rally, and here we are, highs of the day as we begin the final stretch, and it's a similar kind of story, right? All these mega cap stocks, not a one, are in the red.
Yeah, I mean, as we talked about the last few weeks, I mean, in years where the market's up a lot, January through October 31st, it almost always rallies November and December. I think there's been 38 years in the last 100 years that you've been up 10% or more, and then the market's up 32 of those 38 the last 2 months. Is that a self-fulfilling prophecy? Is it people chasing to catch up because they weren't positioned for it?
All the above.
All the above. It's a combination. So, that, and you get, some things you can sink your teeth into about the fundamentals, and you're off to the races. 10-year yield's lower, and people think equity multiples are going higher, and that's, kind of a champagne luge or whatever you call it for the market.
Do you buy into that? Does that make sense to you?
I mean, I think the investors I talk to obviously have been saying for a while they think this could happen, as we have. But I think the question is, what did they sell in December? What could rotate in January? A lot of people are asking about that because it seems like 100 years ago, but it was only a year ago that Tesla, Meta, and Nvidia were awful stocks in 2022, and then their low was really January 3rd, first trading day of this year, and they've ripped basically all year. So I think people are trying to figure out what is it that's lagged this year that maybe could get the rotation, benefit next year. Is it healthcare that looks oversold? Is it staples that are probably down too much on GLP-1? Is it something else that maybe gets a benefit of a flow if people end up selling these things in January? But for now, it seems a bit of a fait accompli.
Do you think that those other areas that have done, a lot of nothing are going to do something as the calendar turns? Energy, materials, you said healthcare, staples, things like that?
I mean, energy, materials, and healthcare are our three biggest overweight recommendations. So I think they have good risk reward, better than average estimate achievability, and people aren't positioned for them. So it looks to me, each one's separate. There seems to be like one of those, mythbuster things where everyone just says, oh, healthcare's bad in an election year. And like as if it's definitely going to happen. But I look at some of the names and I think, so you're telling me people are going to consume less calories and live longer, but they'll need less health care? Like some stocks are implying some implausible scenarios in med devices and other areas. So I'm really warming to the fact that the estimates are low and some of them look pretty cheap. And then obviously I like, some of the healthcare services, just, even things like United Health as a customer, all they do is raise pricing on me every single year, and they give me zero choice. So they have pricing power on me, and I think these companies have good earnings growth unless you get a recession and small and medium businesses go out of business. If I go out of business, they won't make money from me, but short of that, they're going to raise pricing every single year on me, and guess what? I have to take it.
But I mean, are we at a position now? The Russell's up 7.5% in a month. Is there staying power there? Is it time to take a serious look at the Russell, or as long as you have the overhang of possible recession at some point in 24, do you have more risk?
I think the Russell, I don't like to call it the small caps over large. I don't like that call, and I don't like it for many reasons. First of all, you want to own those businesses when you're right before, let's say 2 to 3 months before the Fed's really going to cut, right? So if you think we're going to cut in February or March, and you think this is the maximum level of pain in earnings, and they can't take it anymore, and they have to cut rates, then yeah, you buy small caps on an anticipation that the accommodation will ultimately result in their earnings growth and margin expansion. Where I am now, I look at it, I say, no way do they have more achievable estimates than the Big Seven. We know why the Big Seven are up. Their estimates are more achievable. Okay, they're more achievable. Why? Labor, materials, depreciation, pricing, mix, all the things that make them awesome companies continue to make them relatively awesome companies until you get closer to the bottom. At that point, then you could dream the margins can expand more for small caps.